The story of China's economic rise has captured the world's attention for decades. From its meteoric growth after the 1970s to becoming the world's second-largest economy today, China's economic success has been the subject of awe, admiration, and sometimes skepticism. Every year, China sets an ambitious growth target. But how much of this is real? And how much is carefully curated for global and domestic consumption? In this video, we'll examine the intricacies of China's economic performance, the challenges it faces, and whether the country's official statistics truly reflect the reality on the ground. But before we dive into today's topic, please hit that subscribe button to help us reach our goal of 1,000 subscribers. Your support means the world to us, and it's greatly appreciated. Every year, China sets ambitious growth targets, and every year, the world watches with bated breath to see whether it will meet or exceed those expectations. For 2024, China has set a growth target of 5%. The country's leadership touts this figure as a sign of economic stability and strength. However, there's something lurking beneath these numbers that begs for closer inspection. In recent years, China's growth has been underpinned by some very aggressive policy decisions. These actions have been taken to support the economy at what can only be described as unprecedented levels. But the question is, why does China feel the need to take such extreme measures to maintain the illusion of growth? And more importantly, are these actions masking the true state of the economy? To understand this better, let's first look at some of the data that China itself has released. Officially, the Chinese government reports a solid growth trajectory, but when you break down the numbers, they tell a different story. Key sectors, which once accounted for a significant portion of China's economy, have shown signs of strain. The real estate sector, which used to represent as much as 25% of the country's GDP, has been struggling. Property construction has plummeted by as much as 68% compared to the peak levels of 2021. At the same time, local government investment in infrastructure has dropped significantly. This is a crucial point because, historically, China has relied heavily on real estate and infrastructure investments to drive economic growth. Yet, nothing has truly stepped in to fill the void left by these declining sectors. The slowdown in these areas, particularly in property and local government infrastructure, has had a ripple effect on the economy. While exports, particularly in trade, have helped cushion the blow, overall investment activity remains sluggish. In fact, China's credit growth, which has always been a key indicator of investment health, hit an all-time low in 2024. Credit is the lifeblood of investment in China's economy. So when the financial sector pulls back, it signals that the economy is not operating at full capacity. Without a boost in credit, it's difficult to fuel the kind of robust economic activity that China has long depended on to reach its growth targets. Another alarming indicator is China's consumer spending. For years, the government has talked about the need to rebalance its economy towards more domestic consumption. Yet, the numbers suggest that consumption remains weak. Retail sales growth has been sluggish, and consumer confidence is not where the government would like it to be. When looking at China's nominal GDP growth, which adjusts for inflation, we see consistent weakness. This indicates that the economy is not growing as quickly as the official real growth numbers might suggest. On the surface, it may appear that China is meeting its targets, but in reality, the growth is far weaker than advertised. In 2024, we saw China take some drastic steps to shore up its economy. Some of these measures included new consumer subsidy programs, especially in sectors like autos and home appliances. There was even a massive mid-year budget adjustment in 2023 and the issuance of a local government debt swap worth 10 trillion yuan. These measures were aimed at freeing up funds for local governments to spend and invest. Additionally, the Chinese government rolled out several initiatives to boost consumer confidence and spending, including press conferences from various ministries, all touting their efforts to help the economy recover. But why the need for such extraordinary interventions if the economy is performing as well as the government claims? So why does China continue to project such optimistic growth figures? There are two primary reasons: bureaucratic necessity and political strategy. The Chinese government has long used its annual GDP growth target as a way to manage expectations and motivate local officials. If the growth target is too low, it sends a signal that economic growth is no longer a priority, which could have political repercussions. The second reason is more politically charged. China's government is highly invested in projecting an image of global dominance. The idea is that China will inevitably rise as the leading economic power, but this vision becomes much harder to sell when the economy isn't living up to the hype. To maintain this image, China has been pursuing a growth strategy centered around investment and manufacturing. But there's a catch. If China remains an investment-heavy economy, it will have a tough time growing relative to the rest of the world, especially if other countries aren't investing as much. This has led to rising trade tensions, particularly with the West, as China's investment-heavy model is increasingly at odds with the global economy's shift toward consumption-driven growth. Looking ahead, the question becomes, can China realistically achieve the 5% growth target for 2025? While the country's leadership may aim for a modest improvement in growth, the challenges remain. Structural changes in China's financial system are necessary to sustain long-term growth. China's banking system is already the largest in the world, but it's difficult to maintain the kind of growth needed to keep up with investment demands. The country has also struggled to transition from an investment-driven economy to one led by consumption. Despite efforts to encourage domestic spending, China has yet to make meaningful strides in boosting household incomes or rebalancing the economy. For real progress to occur, China would need to undertake significant fiscal reforms, focusing on redistributing wealth more equitably across society. One of the key factors holding back China's economic transformation is the imbalance between investment and consumption. For years, China has aimed to shift its economy towards greater domestic consumption. Yet, this has proven difficult due to structural problems, including income inequality and the over-reliance on state-led investment. The problem is not a lack of desire to change, but rather the deep-seated challenges that must be addressed for such a shift to be meaningful. These challenges include everything from labor market reforms to adjustments in the taxation system. The reality is that making these changes will take time, and they won't happen overnight. Ultimately, the question is whether China will continue to pursue its growth model focused on investment, or if it will pivot toward a more sustainable model based on domestic consumption. The road ahead will depend on how effectively China addresses its internal economic challenges. China's future will likely see a combination of both strategies, continued investment in key sectors while trying to boost domestic consumption. However, the larger question remains. Can China really transition to a consumption-led economy without first addressing the deeper structural issues that have long plagued it? As we look at the future of China's economy, one thing is clear. The path ahead is fraught with challenges. The question of whether China will be able to sustain its previous growth levels, or if it will enter a period of more modest growth remains to be seen. But one thing is for certain. China's economic model is at a crossroads, and the choices it makes in the coming years will determine the future of the global economy. Thank you for watching. Stay tuned to our channel for more insights on the fascinating world of global economies, and don't forget to subscribe to History and Curiosities for more videos like this.